Okay, so here we have Gino Livrini, who came to my video on how to predict earnings surprises. He said he was looking for a way to use options to predict earnings. Now, you can use options in predicting earnings, and he's asking me why I didn't mention that. The reason is pretty simple. There's nothing special about options when predicting earnings because options always lead the market. The options market moves prior to the stock price moving. And it doesn't specifically target earnings, it targets all events. So it could be that investors in the options market know something about the upcoming news of a stock or analyst price revisions. All of that stuff can be reflected by the options market. Now I'm going to show you how to do that in this video, but I just wanted to preface this with the disclaimer that you don't need options to predict earnings. They're useful, and everything I showed you in this video can be used in tandem with what I'm going to show you in the video I'm making now. So again, you're going to be using options to predict events and significant price movements when you don't have that information. So the idea behind it is simply that people who are buying these options have inside information, or they're noticing something that's going to happen with the company in the future, and they found that that event, whether it be earnings or a news article that's going to come out and explain something about the company, is not reflected in the price of the stock. What they do is they go on the back end and buy the options. Now, like I said, the options usually lead the market, so if you want to know which way the price of the stock is going, even if you don't play options, using options is quite useful. What I'm going to do is I'm going to just pull up a chart. I'm going to remove volume because we don't care about that, and I'm going to add some things in here. First thing I'm going to add is the call and put contract volume. That's the number of call and put options out there. Now, if you recall, call option is bullish and a put option is bearish. I'm also going to add the statistical volatility and the implied volatility. And these two charts together can give you a good idea as to what the options price, or the options market is saying about the price of the stock. So here's the price of the stock. Like I said, the options market typically leads the stock market. Alright, so a couple things we need to look at. First is the volatility difference. The green line is the implied volatility. The yellow line is the statistical volatility. Now, in terms of pricing options, options become more expensive when implied volatility rises. And when you see the implied volatility rising without the statistical volatility rising, that means the options are technically overpriced in regards to how much that stock actually moves. So here we would say that options are overpriced, and if you're playing options, this is a good time to sell options, not a great time to buy options. But the fact that there's this big skew here means that at this point, where the skew pretty much evened out, at this point, options traders decided that there was something very different about the price of the stock and what will happen in the future with the stock. So this skew here tells us that something probably will happen in the future, and the options market is accounting for that. Now, unfortunately, this skew doesn't tell us the direction of that movement. For that, we need to go down to the put and call difference. Now, if you don't see a clear pattern, right here, we should be seeing a clear pattern with the difference between puts and calls. But we don't see that down here. And in that case, you might want to look at a different version of the call and put difference. For example, the open interest should be smoother. But again, we don't really see a huge difference here. So usually you'll see a chart like this, where it's either usually puts are more common than calls. And I really don't like that chart because there aren't a lot of thresholds for crossing. So I'm just going to revert and bring us back to those original two charts. And I'm going to switch over to something else. How would I describe this, by the way? I'd say at this point, investors started to get, or traders started to get a little worrisome, and they bought a bunch of put options. And you can see put options are still more popular than call options. So the options market seems to be expecting a downward movement in the QQQs. Let's move on to something. Let's move on to Salesforce. All right. So here, Salesforce. I guess this was earnings. I think I might have even played this earnings. This gap up was probably an earnings report or some other event. And as you can see, the volatility here, the implied volatility here was much higher than the real volatility. Now, after that earnings report came out, the volatilities, the skew pretty much evened out, and now there isn't much expectation in the market. So this is kind of boring, and you wouldn't want to play this because the volatilities are simply too similar. You want to look for something where the volatilities are quite different, or you've seen a crossover. Now here is Energizer. We see a crossover here. The implied volatility has fallen below the statistical volatility, which means that option traders really aren't expecting much movement in Energizer. So there's probably not an earnings report coming out soon. There's no insider information regarding news or analyst estimations or price revisions. So we've seen that implied volatility drops below the statistical volatility, making options relatively cheap. Now we notice here actually the options market is saying that Energizer is overpriced, and there's a lot of put buying relative to the green line, which is call buying. We see there's huge amount of put buying here. So the options traders are predicting, probably based on fundamental reasons, because we don't have a high implied volatility here, they're predicting either based on fundamentals or based on technicals that Energizer is going to be falling. Now, like I said, this volatility difference tells us what's coming up in the market. So if there's an earnings prediction being priced into the options market, you're going to see the green line and yellow line deviate from one another, and you'll have a big gap in between them. So what are some stocks that have earnings reports coming out? Well, we've got STZ, and as you can see, the green line has gradually outpaced the yellow line. Now earnings is coming up. The options market is clearly pricing that in because there's a difference between these two lines, and based on the put and call ratios, it looks like there's a lot of put buying, which is tapered off. What we can do is we can actually switch to the parity to see whether we're at parity or not. So you look at the ratio, and here if we look at the ratio, we see that we are at pretty much we're at parity. So there's an even number of calls and puts. In other words, the options market really doesn't know where STD is going, STZ, where STZ is going, but they know it's going somewhere, and that's where we see this implied volatility moving upward, whereas the statistical volatility is trending sideways or going downward. Now, how do you know how much SCZ? How do you know how much the movement is going to be based on that options price? What you can do is you can check the straddle of an at the money for the most for whatever time period you're looking at. Okay, each trade is broken right now, so that will be another video. But for now, what you need to do is, if you're looking to predict an earnings prediction, earnings surprise, go ahead and type in whatever you're looking at and check out whether there's been a deviation in the statistical volatility and implied volatility. So here we can see implied volatility has been above and now been below, and now it has risen above the statistical volatility. So it's possible that there's an event upcoming, and to confirm that, we would want to, well, first of all, look at all the data related to the ticker, But just by looking at the options market, if that skew becomes larger, if we see the green line continuing upward and the yellow line continuing downward, then we can safely guess that the options market is expecting a significant movement in SIG. And the direction that they're pricing in is confirmed by a difference between the puts and the calls. So as you can see here, it looks like some investors are loading up early on puts in expectation for something ahead with this stock, Signet Jewelers. So it could be a piece of news coming out. It could be an earnings report coming out. But just remember that the options market tends to move faster than the stock price moves. And if you don't believe me, you can go back. I'm saying this based on statistical studies, but you can actually go back and look at the stock in question and confirm that. So you can see here that when implied volatility was higher, even though the stock was trending sideways, implied volatility spiked, and there was quite a bit of confusion as to whether puts or calls were better, but it looked like more put buying was going on, and indeed something happened. The stock price fell significantly, and then the volatility tapered off, and that's what happened. So if you were holding a put, like many of the options investors were doing, before the implied volatility fell, you probably made some money. But again, one of the weird things about options is that if volatility falls, the options price falls as well, because you're basically long on volatility. And in that sort of situation, you need to learn how to hedge volatility but still be long delta in whichever direction you want. And that could be a subject for another video. But for now, just a summary of this. If you are going to be using options to predict earnings, know that options is not specifically used to predict earnings. It can be used to predict pretty much any large price movement in a stock, typically due to any sort of new information that is released by the company or by clients or whoever's related to that company. So whatever new information hits the market is expected by the options market, and you can tell that they're expecting something if the implied volatility is significantly above the statistical volatility, and that you're going to get a signal for that when these lines cross. So when you see the green line crossing above the yellow line, that's your indication to start paying attention. And which direction it's going to move is typically defined as whether the put volume is higher than the call volume or vice versa. Remember, these are all reflecting some sort of expectation of options investors or actual insider information. Now, because you have some of that as insider information, generally you could just side with this strategy, side with whatever the market, the options market, is tending to side with. So here, as we see put options are outpacing call options, we generally want to side on the bearish side, even if we don't have information on that. And this is a good way to develop a thesis. So you come and you look at stocks, you figure out which one has increasing implied volatility versus the statistical volatility, and then you look at which options are being bought. Now you have a pretty good thesis. Then you can go and do additional research into that ticker to figure out why that might be so. And in many times, in many situations, you really can't get a full grasp on what's happening because, like I said, a lot of this is insider information being reflected in the options market, which tends to lead the stock market. So we're kind of blind here in terms of why this is happening, but at the very least we know that it is happening, whereas many stock traders who don't look at the options market are completely blind. They have no idea what options traders are doing, and because of that they often make the wrong trade or they ignore a contrarian opinion. So you might see, for example, let's imagine that everybody loves this stock, but like everyone in the market is saying good things about this stock, but we see the options market starting to buy a lot of puts. Well, that means some people, I'm not saying options traders are smarter, but people with a lot of money on the line or speculators are going the opposite direction. So you've really got to look and make sure that your thesis is backed up by the options market. Otherwise, it might come back to hurt you. If this video has proved helpful, please subscribe and like this video. If you have any requests for a similar video, please leave that request in the comments section below and I will get to it. I always do requests. This was a request. So just go ahead and put in your request and I'll get to it.